this is Dr. T. Lakshmi discussing you about the capital and its significance as a part of business economics and financial analysis. Capital, the money or the monetary items which are invested in the business is called as the capital. Like money means any currency which is approved by the central bank of that country. Like in our country, RBI has approved the rupees as the legal currency. That money or the monetary item equivalent to the money, like the gold, vehicles, buildings, machineries, computers, etc., which is added to the business activities is called as the capital. Okay, so why it is calling as the capital means, why can't it be called as the money or the monetary items, means that money or the monetary item is turning into a purposeful fund for the successful running of the business. That purposeful funds which are accumulating from the shareholders to the business is called as the capital. As a business person or in the economics, every business person should take care of this capital and he has to apply the economy concepts to the capital. If he won't apply this capital economy concepts to the capital, there is no idea about where to get the funds, and he may take the funds from the bank, but the bank may be charging 24% of the interest rate, but he has the facility to get this funds from the government with less, that is 10% interest rate. Instead of paying 24% of the interest rates, it is better to pay the 10% of the interest rates, so that they can reduce the cost and they can increase the profit levels. That's way, as a part of the economy applications to the business entities, it is better to know what is the capital, how many forms of the capital are there, what are its significance, what is its usage for the business entities. So generally the people will think that the workers, raw materials, papers that are all using for the business will be called as the capital. Definitely not, because from the funds accumulated by the business is going to be spending for the workers in the form of the wages and the salaries. They're going to be spending for the papers or any inventories or the stationaries. And from the funds which they have acquired, with that one only they are purchasing the raw materials. So that's why they won't be treated as the capital. Then, if the funds has accumulated from the business activities and they are going to be purchasing the machineries, can they called as the capital means? Definitely not. But if X person has started the business, he has 10 lakhs and already he has the machinery with him, he has some computers with him, some vehicles are all there with him, some buildings are all there with him, and he is going to be using for the business activities, means he is investing them for the business activities. From the fronts, he is not purchasing that one. From already whatever existing things which he has, and that is going to be venturing to the business activities. In that case only, they will be treated as the capital. But the same computers, the same machineries, vehicles, buildings they have purchased from the funds which has taken from the banks or from the shareholders, then they won't be called as the capital. So that's why the meaning of the capital is the money or the monetary item which is going to be accumulating, that is to bringing to start that particular business, is called as the capital. So that's why, for the easy communication of this capital, this is divided into two things, that is debt capital as well as the equity capital. The funds which is accumulated for the business in the form of the debt, which means they have to repay with including interest rate, and the person who is no way related to the profits or the losses gaining by the business, that investor is called as the debt holder, or that kind of the capital will be called as debt capital. And the person who is going to be investing into the business activity and he is also responsible for these returns and profits of that business, that kind of the capital will be called as the equity capital. Generally, they will expect the returns in the form of the dividends. Let us say the 100 crores capital is required to start the business. Then, out of this one, 60 crores is accumulated in the form of the loans or the bonds. Then this 60 crores will be called as debt capital, and the remaining 40 crores, 20 crores is invested by the owners, and the remaining 20 crores invested by the investors, but who are taking the same responsibility and the roles of these owners. Then that 40 crores will be called as the equity capital. By using this 100 crores, they have started the business. Every rupee should be accumulated and accountable in the business activity. If they have invested 100 crores 1 rupee, this 1 rupee is also should record as a capital, because every rupee is accountable for every business activity. This portion of the or the combination of the debt and equity is based on the business risk and the financial risk. Let us say if that organization has more business risk and in the market conditions there is no chance of getting the profits, at that time it is better to have the more equity than the debt, so that the equity shareholders will share the losses also. And if that business is having the less market risk and there is a scope for high profitabilities, at that time instead of giving shares benefit, if they pay less amount of the interest rates, then there is a chance of getting maximum profits. At that situations, the organizations will go for the high debt, low equity. So based on this business risk and the financial risk of the business activities, they'll go for the proportionate between the debt and equity. That proportionation or the combination of the debt and equity to the business accumulation is called as the capital structure. So here the debt or the debt funds will be called as the borrowed funds. They can borrow by issuing some bonds. That bonds or the shares is called as the debenture shareholders. Instead of that one, if they have issued the bonds only, then the funds which is accumulated is called as the term loans. And if they have taken taken from the public on the bills basis, then it will be called as public deposit. For example, let us assume that 100 crores capital is required for the organization, out of which 60 crores are in the form of the equity and 40 crores is in the form of the debt. Out of this 40 crores, 20 crores they have issued some shares with interest rate. So that shares will accumulate will give the interest rates to this holders. Then that shareholders will be called as the debenture shareholders. The remaining 10 crores they have taken from the banks as the loans. So that too 6 crores they have taken as the long-term loans and 4 crores they have taken as the short-term loans, which can be repayable within 1 year time period. Then that will be called as the term loans. The remaining 10 crores they have taken by giving the promissory notes. Generally, these promissory notes will get the discount rates, discount rate basis, that is bills. We will call them as the bills. So let us say each bill price is 1 lakh rupees. 1 lakh rupees. Then they have to issue the 100 bills to accumulate this 100 crores of the returns. And each bill price, 100 bills they are all selling with a discount rate of 10%, means if the investor invests 90,000, then the organization will pay 1 lakh rupees to the investors. That deposits will be called as public deposits in the form of these bills. But they are all taken, they have borrowed the funds and they have the responsibility to repay that funds to that these kind of the people. That kind of the return, that kind of the funds which is accumulated to the business is called as the debt funds, which is a combination of debentures, term loans, and public deposits. Remaining 60 crores equity, here 40 crores are taken on the basis of the equity capital, and 20 crores they may take in the form of the preference capital. Whereas in this 40 crores, again 20 crores are all invested by the owner of that organization. The remaining 20 crores are from the other investors. So here the 20 crores preference shares were issued at the rate of 50% risk, means if the organization will get the profit of 1 rupee, these people will get 50 paisa only. At the same time, if the organization will get the loss of 1 rupee, this will be bears only 50 paisa, because they are at 50% risk preference shareholders, because the risk taking by that equity shareholders is limited. That equity shareholders will be called as preference shareholders. But the people who will take 100% of the risk and the returns, which means if the organization will get the profit of 1 rupee, 1 rupee they will take. If the organization will get the loss of 1 rupee, then that person will also get the will face that 1 rupee loss, as well as the remaining loss which is incurred by the preference shareholders, as well as the profits are also enjoyed by the same equity shareholders. So here the owner has some separate rights and responsibilities, but the investors will have only the benefits of their investments as per their risk taking. That is the equity capital. That's way every time if the business yields the benefits, assumes that with this 100 crores they have achieved 1 or 2 crores, means 2 crores of the benefits is there. 1 crore again they can invest into the business, that is called as retained earnings. The remaining 1 crore, if they want to distribute to the 1 crore number of the shareholder, each shareholder will get 1 rupee. And that too, in this 1 crore, first they will pay the interest rates to the debenture shareholders. Let us say 40 lakhs they have paid to the debenture shareholders in the form of the interest rate. Remaining 60 lakhs, they will pay to the, assume that they are paying 20 lakhs to the preference shareholders. Remaining 40 lakhs will be distributed among equity shareholders. Same as with the losses also. So that is the capital structure, and that's proportionate between the equity and debt. If we see these characteristics of this capital structure decides the size of the capital. That is how much of capital is there and how many shareholders are all there, and that too how much of funds should be in the form of the debt and how much of funds should be in the form of equity. And that too, this capital structure will decide the liquidity position of the business. That is how easily they can convert that particular business organizational funds into cash. That is how much of cash is there, cash at bank is there. That combination of the capital structures will be deciding by the capital structure, and how much of interest they have to cover, and what is the scope for the business growth, and what is the tangibility of that business activities. That is how much they can touch. Intangibilities. Tangibility means the assets which they can touch, like the land, machineries, etc. If any goodwill, brand images are all there, they are all called as intangibilities, but the capital structure will more concentrates on the tangibilities, and that too quantitative elements are only. And also it says about the age of the firm and its perpetuality. So based on this capital structure, the types of the capital is decided based on various bases for that one. That is, on the basis of the durability, it is categorized as fixed capital and circulating capital, which is also called as the working capital. For example, if the funds accumulated by the business is going to be using for the purchasing of this machineries, lands, vehicles, etc., then that capital is called as the fixed capital. But if they are spending for this stationaries, inventory, for the day-to-day operations, then that capital will be called as the working capital. And based on the mobility of that capital, it is categorized into sunk capital and floating capital. The capital which is investing may not earn or the returns, then it is called as sunk capital or non-recurring capital. They have invested, they have started the business, and uh, they are distributing under the corporate social responsibility. They won't get any returns. That is called as sunk capital. And the capital which is going to be incurring or the returning again with the benefits to the organization, then it is called as floating capital. And on the basis of the nature, it is called as real capital. The money really which is invested or the assets which is really invested into the business is called as the real capital. The human capital, like labor, employees, brainstormings, which they have invested in the business, is called as human capital. Tangible capital, which they can touch, that is machineries, lands, furnitures, goods, etc., will be called as a tangible capital. And the intangible capital, like their patent rights, designing rights, copyrights, will be called as the intangible capital. And the only in the form of the liquidity form which is invested into the business organizations is called as the money capital. And based on the ownership, it is divided into two things: individual capital and social capital. A single person invested into the business organization, that is called as individual capital. As a part of this another business organization, if they have invested, that is called as the social capital. Let us say a government of India has invested some funds on the SBI, that is called as the social capital. Or Reliance, in the Reliance, another Infosys is having some share capital, that is called as the social capital. If we see the functions or the usage of this capital based on the procurement of the funds, that is sources of the funds, its objectivity is to maximize the cost. So because they want to reduce the cost and they want to minimize the expenditure incurring on that front. So in this procurement of the funds, there are two ways to acquire the funds, that is long-term sources as well as short-term sources. Long-term sources of the funds is own funds, that is the equity, or the loan funds, that is the debt. For the short term, again, they can get these current liabilities like creditors, payables, etc. And from the current assets are also they can get that one. Then once if they have accumulated that funds, they have at the time of the utilization, again they can spend it for the short-term activities of the business or for the long-term activities of the business. So here if we see, all these are all the incomes. Rupee comes in sources for the business organization. These are all the rupee goes out sources for the organization. Like short-term investments to the organization, like stocks, debtors, cash, etc. And for the long-term investments, fixed assets and projects. So generally, this will be called as capital structure decisions or the financing decisions, these two. And these current liabilities and current assets decisions will be called as working capital management decisions, and the fixed assets and projects decision will be called as investment decisions or the capital budgeting decisions. This importance of this capital analysis is going to be benefiting to maximize the returns of the organization and to decide the flexibility of acquiring the funds by the organization, as well as to estimate the solvency position of the business organizations and increases the firm's value with the best analysis of the fund acquiring. And it will also helps in reduction of the financial risk occurring to the business activities and minimizes the cost of the capital. And tax planning can be possible with analysis of the capital, and optimum utilization of the funds can also be possible with the knowledge of the capital. And the planning of this capital is called as the capital budgeting. That is, before going to be investing into the any activity, shall I purchase this project or not? Shall I start this project or not? Shall I start this unit or not? Or can they go for the purchasing of that building or not? So such kind of questions are going to be answering with the help of the capital knowledge. That decisions answering is called as the capital budgeting. This significance is more on the business because they are dealing with the huge investments, and it is possible for the expenditure control, and it deals with the investment decisions of the organizations to yield the profit maximization as well as wealth maximization of the businesses, and to reduce the risk and uncertainties estimations of the business, and flexibility of the liquidity of the firm and control over the firm, and to determine the cost of the capital. This capital budgeting analysis is more important one that anyhow I'll see in the next class, next video of this related to the capital budgeting. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.